Welcome to our Cost Segregation Software Tools and Tax Strategies webinar. Today's speaker will be our director from our New York office, Sumit Sharma. KBKG is headquartered in Pasadena, California, with additional offices in Illinois, New York, Georgia, and Texas. Since 1999, we have successfully conducted thousands of studies nationwide. KBKG's team has performed studies on facilities ranging in size from 10,000 to over 1 million square feet, resulting in the deferral of hundreds of millions of dollars in taxes. We also have highly qualified engineers and tax professionals on staff. Our engineering department has extensive construction experience in reading plans and utilizing RS means and Marshall and Swift cost estimation techniques. Our tax department provides support for all cost segregation tax-related issues, including 1031 exchanges, AMT, passive activity, abandonment write-offs, and lease provisions. We are a preferred provider for thousands of CPAs across the country. Now I will introduce our speaker, Sumit Sharma. Sumit is a director at KBKG for the cost segregation practice. Based in New York, he has over 10 years of experience conducting fixed asset depreciation reviews, purchase price allocations, cost segregation studies, Section 179D energy efficient analysis, repairs maintenance cost analysis, and pre-construction tax consulting services. Prior to joining KBKG, Sumit worked for 6 years as a tax manager with PricewaterhouseCoopers in their tax projects delivery group. His experience also includes 5 years at a boutique consulting firm where he was engaged in various fixed asset tax consulting projects. His technical knowledge spans across various tax projects, and his experience includes a diverse mix of clients in various industries. Now I will turn it over to Sumit.
Thank you so much, Ellen. Good afternoon, everyone on the call. Thank you for joining us today. So we'd like to begin this webinar with going over a few of the learning objectives that we're going to be covering today. This webinar presumes that the members or the attendees have some basic knowledge and understanding of cost segregation. The main premise of this webinar will be to go over the cost segregation tools, the residential cost segregator and partial disposition calculator, but we will be spending a little bit of time. We will spend and briefly go over the benefits of doing a cost segregation study, mention some of the tax implications that you need to consider in conjunction with these studies, including a brief discussion of some of the new tax laws. I'm also going to be discussing some tax strategies and planning considerations that you may not have thought of, especially as they concern to estate planning. And then finally, as I mentioned, discuss some of those proprietary softwares and tools that we've created that are available on our website. The cost segregation has been around for decades, although many taxpayers and tax preparers are unaware of it. The IRS, on the other hand, is very well aware of it, and they actually expect taxpayers to do cost segregation studies. There is a published Cost Segregation Audit Techniques Guide, or ATG, that was prepared by the IRS to assist their examiners even when auditing returns that have cost segregation studies in them. You can actually view the entire Audit Techniques Guide on our website or on the IRS website. So this is a service that's quite mature. It's been around for many, many years, and there is that expectation that taxpayers appropriately categorize and depreciate their capital expenditures, properties that have been acquired, properties that have been built, or properties that have been improved. So any cost that taxpayers are capitalizing, that they are appropriately categorizing them. We'd like to say that there's two goals. The primary goal of a cost segregation study is to identify the depreciable real estate related costs that can be depreciated into faster or shorter recovery periods. As we know, commercial real estate and residential real estate depreciate over a 39-year and 27.5-year period, respectively. But there are personal property assets that can depreciate in faster or shorter recovery periods, 5-year, 7-year, or 15-year. The secondary goal of a cost segregation study is to identify the depreciable tax basis for each major building component that is likely to be replaced in the future. So not only appropriately categorizing costs, but also itemizing costs. Examples of these itemizations and these building components, they would include the roof membrane, the structure, windows, doors, bathroom fixtures, the mechanical, electrical, plumbing systems, HVAC, and so on. So When a component is replaced, say down the road in the future, taxpayers can use that information and use that information to identify the retirement loss or the adjusted taxable basis on that asset that has been removed and capitalize perhaps the asset that's being put in place. You may be wondering what types of real estate transactions are good candidates for cost segregation study. The most common scenario are existing properties that are either acquired by a taxpayer and the purchase price is then recovered over the appropriate recovery periods. New construction projects are definitely another big area where we perform a lot of cost segregation studies. These are, costs for projects that have been placed in service. The taxpayer is actually the person incurring the cost to construct the property. Many taxpayers also incur costs to remodel an existing property or a tenant improvement, something like that. And depending on the facts and circumstances, these costs can be quite significant and end up being capitalized as well. And finally, the last scenario I'll mention is build outs. So if you're building out, like I said, of a tenant space, all of these would typically include costs for interior construction within an existing building shell and are certainly areas where we find a lot of benefit to do cost segregation. You might be surprised to know that you can do a cost segregation study on properties that were placed in service in a prior tax year. So despite the fact that it was placed in service maybe 5 years ago, 10 years ago, as long as there's taxable basis left in the asset or the property, you can go back and claim those missed deductions. So as a practical matter, it's usually most beneficial to focus on assets that were placed in service, I would say, in the past, 10, 15 years, something like that. That's typically where we see assets or property with enough remaining basis to justify or warrant a cost seg analysis. So let's take the example of a $3 million retail building that's being depreciated straight line. So commercial building that's being depreciated straight line over 39 years. So as a result of the cost seg study, we may identify $330,000 of short life 5-year tangible personal property and another $360,000 of 15-year land improvement property. So the reclassification of this basis or of these assets into these shorter recovery periods would result in increasing those deductions in those earlier years. It's really a timing play here. So as a result of this analysis, increased deductions over the first 5 years of $333,000. So quite substantial there. Tax affect that.
Okay? Food? Okay.
Tax affect that for at a tax rate. You can looking at cash tax savings of about $132,000 over the first 5 years. So as I mentioned, cost segregation has been around for a while. It's been around so long that it's one of the most common tax planning tools that CPAs or taxpayers in the real estate industry consider. You can do a study anytime after the building is purchased without filing an amended return. And you do this by filing a Form 3115. So as I mentioned before, even if it's an asset that's been placed in service in the past, you can still look at that acquisition or that construction, perform a cost segregation on that asset, and catch up those deductions via a Form 3115 change in accounting method. And you would be able to catch up all of those deductions in the year that you apply the study or in the year that you file the Form 3115. So this is very important for tax preparers to consider. If you have the probability of a significant taxable event in a future year, you can delay the study. So you can strategize there and use timing to strategize when you want to implement the study in the year that you're really going to need those deductions. So that's one thing that you have in your tool belt there. And as I mentioned earlier, many taxpayers, were sort of expecting that those drops in rates, and so they really took advantage of a lot of cost segregation studies in the high tax rate environment in 2017. And so we're able to really take advantage of those deductions as at the end of that year. So one of the rule of thumbs, as you see right there at the very bottom of the slide without the software, one of the rule of thumbs that we like to share with folks, because they often ask, when is the right time to engage a practitioner? When is the right time to do a cost segregation study? So without the tools that we're going to be talking, about later in the presentation, we typically say that, if you have a basis of $750,000 or $1 million or more, is when you really want to get involved with a cost segregation provider and look at the benefits it's around that value. It's just a rule of thumb. It's not a black and white, hard and fast line in the sand there, but just a rule of thumb. If you have a depreciable basis of over $750,000 or more, then it may be worthwhile looking at a cost seg analysis for the property, especially considering the cost of doing these studies. I think once you're below that basis value, sometimes the cost of doing the analysis may not be as, maybe a little bit prohibitive. But that's one of the reasons why we developed the residential cost aggregator tool, and one of the reasons we're going to be highlighting that tool later on in the presentation. For a lot of those folks south of the $750,000 rule of thumb, they were really priced out of the market. And so it's an underserved market, and one of the main areas why we invested time in putting together the software. So the items on the slide, these are all tax considerations you should be aware of when utilizing cost aggregation. These slides are going to be available on our website, so I'll move through these pretty quickly. But just some things that we just want to raise awareness about, that they have some interplay with depreciation, fixed assets, and cost aggregation, and tax preparers and CPAs should be aware of these things when thinking about cost segregation. Depreciation deductions, are going to reduce your alternative minimum tax. Bonus depreciation can apply to reclassified items in a cost segregation study, especially for a new construction project, especially in years where bonus was eligible. Any unused deductions carry forward to future tax years. When a building is sold, the taxpayer, and this is a very important one, when a building is sold, the taxpayer may need to recapture depreciation on those. They may need to recapture depreciation taken on tangible personal property. So depreciation recapture is definitely something to consider if you're thinking about cost seg and also thinking that this property may be sold in the near future. Accounting method changes, as I mentioned before, are addressed via Form 3115, so you can retroactively look at properties placed in service in prior years. Passive activity rules can offset the benefits of doing a cost seg study. If the real estate activity is passive, then you must use the deduction against income that is also passive. 1031 exchange rules need to be considered. Typically, the net increase in the depreciable basis associated with the replacement property is subject to the cost segregation. And then especially with the new bonus regulations and 100% bonus for acquired property, which we'll be talking about on the very next slide, the bonus really is only applicable to the excess basis of the new property. So tax reform, 100% bonus, beginning after September 27th, 2017. 100% bonus depreciation is applicable for taxpayers through 2022. After 2022, it is then scheduled to reduce by 20% each year after that, 80% for 2023, 60, 40 for 2024 and 2025, and so on. The new law no longer requires that the original use of the qualified property begin with the taxpayer. So as long as the taxpayer has not previously used the acquired property and the property was not acquired from a related party, the taxpayer can take advantage of bonus depreciation on their qualified property. So this is a very significant benefit, a benefit that did not exist for taxpayers ever before. The ability to take bonus on used property or used property that they were buying, unless this was something that they were building for themselves, like a new facility, a new hotel, a new apartment building, a new property, or new improvements. Unless they were the original taxpayer, then they weren't really allowed to take bonus depreciation. But now, for properties that are acquired in 2018, acquired and placed in service, I would say in 2018, you can take advantage of this 100% bonus. And as I mentioned, it was retroactively applied for this few months in 2017. So I should say the technical rule is acquired and placed in service after September 27, 2017. Taxpayers that are considered to be in a real property trade or business may want to elect this real property trade or business election and must use ADS, especially if they're electing the real property trade or business election, to elect out of the interest deduction limitations as a result of the tax law changes that would require them to use the ADS system of depreciation for their real property. However, this does not apply to businesses with average gross receipts over the last 3 years of $25 million or less. So it's really for those larger taxpayers that may want to make this interest deduction limitation, or elect out of this interest deduction limitation that will be required to take ADS on their real property. So ADS recovery period is 40 years for commercial property. So it goes from 39-year GDS to 40-year ADS, and for qualified improvement property, and 30 years for residential property. So from 27.5 GDS to 30-year ADS on residential. So keep in mind those things for 40-year and 30-year for their ADS. The result of the mandatory use of ADS is that bonus is not available to the taxpayer. The definition of real property, trade, or business comes under and specifically is specified in Section 469C7, so something you may want to read and consider if you think this applies to you. I will say this, though, that it's only for the real property. Any personal property, like I mentioned before, that's carved out into 7, 5, 15-year categories, the personal property can still continue to follow GDS depreciation rates and would still be bonus eligible. This is really only for the real property. Taxpayers electing out of the interest limitations must use ADS depreciation. I think we've just kind of covered this for all non-residential real property, residential real property, and qualified improvement property. This mandatory ADS requirement for taxpayers, and it's good news. It allows them to elect out of the interest deduction limitations, and it does not apply to tangible personal property. Land improvements are an interesting thing. Land improvements are interesting because we think of them as real property components too. However, this type of 15-year real property is not included in the definition of non-residential real property or residential rental or qualified improvement either. So therefore, those 15-year land improvement property would qualify for GDS depreciation and bonus eligibility. There is something at the very bottom, and this really applied for 2017. Taxpayers were able to elect or opt to use 50% bonus or 100% bonus, or elect out completely. There was that flexibility in 2017. Written binding contract rules. This is an area that we were provided with regulation guidance in August of 2018. There are written binding contract rules that disallow bonus depreciation if an acquired building went into contract before September 28th. So remember that September 27th date that I was mentioning before. So if you were under contract before that date, then you were deemed to have acquired the property, and these new bonus rules are not applicable to you. So example, let's assume a taxpayer closes on acquired property on October 1st, 2017, but they entered into the binding contract at the beginning of September 1st. So they are not eligible for any bonus depreciation on their used property, despite that it's closed and maybe placed in service after that September 27th date. Because they were under contract, they are subject to old bonus regulations, and it did not apply to their acquired property. So when written binding contract rules were put in place back in 2001, when bonus depreciation was first enacted, these rules described a written binding contract as a contract that is enforceable under state law, where liquidated damage provisions can be 5% or more of the contract price. Under this definition, real estate contracts that only limit damage to earnest money that's less than 5% of the contract price will generally not satisfy the definition of a WBC or written binding contract. So we advise our clients to, at least consult with their attorney or tax advisors regarding the binding nature of their contracts, especially if they're really falling in this kind of critical period where they may or may not qualify. In Section 754 step-up elections, they are also able to receive the new bonus as long as there is a new partner coming in and the property hasn't been used by the taxpayer before the step-up, so they can receive the bonus. But step-ups on death is specifically excluded. So those 754 step-ups, when someone is perhaps inheriting a property due to a death in the family or something like that, those 754 step-ups are excluded from the new bonus rules. Cost segregation, as we mentioned, very useful tool, and it's very useful, especially in estate planning. So I'm going to move pretty quickly through this one. I do want to get to the live demo, please apologize for the talking a little bit faster here. But when a building owner dies and a property is inherited that has appreciated, any gains that have been built up during that decedent's life are forgiven. the person who inherits the property, that beneficiary, receives that property at a stepped up value or fair market, typically fair market value. And then depreciation essentially starts all over again. It's almost as if it's an acquisition for that person, and they put that on their books, and depreciation starts all over again. The clock resets at that fair value. Because of the step up, there is this time-sensitive opportunity to apply a cost segregation study to the decedent's pre-stepped up basis, and essentially creating a permanent tax deduction, because that decedent's going to have to file a final return for that period of the year that they were still alive. So to illustrate this, we're going to look at a building that was purchased by a decedent in 2008. The death happens in August of 2015. The original investment of the building was $1 million. It's a residential property, so depreciated over 27.5 years. So by the time of death, the decedent essentially still had about $728,000 of basis that was undepreciated. The remaining basis left that they never got to deduct. The estate's going to be filing a return for that period in 2015 that they were still alive. Now suppose that if that decedent had sold the property for $2 million, there would have been a pretty significant taxable gain of almost $1.3 million. It doesn't happen in this situation, obviously, but the beneficiary is going to have to step up this property. If the fair market value is $2 million, that step up their value and place it in service for that $2 million basis going forward. Most taxpayers would see that as an opportunity to do a cost seg on that $2 million essentially acquisition, or that new asset for the beneficiary, but they're missing out on that opportunity to take advantage of cost seg, especially time sensitive, on that last return for that period of time for the decedent's final return. This strategy typically yields the greatest benefits for the estate, because these deductions would have otherwise essentially been lost and never been taken. So in our case study, in the decedent's final tax return, if it's filed along with the 3115, as I mentioned before, that remaining basis of $728,000, we did a cost seg, and lo and behold, another $174,000 of deductions were identified that would have never been taken. So on that final return, those deductions are able to, it lowers the decedent's tax basis. It doesn't really matter, about the built-up tax gains, because the beneficiary is going to step it up anyway to fair market value. So I think on this slide you can see the illustration that we're talking about. The additional $174,000 of deductions at a 40% tax rate would be approximately a tax savings close to $69,000. And now I mentioned this needs to be done on the decedent's final tax return. That's because when a building is acquired in a tax year prior to death, in order to apply a cost segregation study at 3115 is required, and generally cannot be filed on an amended return. So it's essentially like killing two birds with one stone here. You can take that study and essentially with minimal refresh and with minimal additional cost to refresh the cost seg study, you can apply that analysis, that general cost seg analysis, to both the beneficiary's $2 million value and also the decedent's pre-stepped up value. So something definitely to consider. We do see a lot of folks, taking advantage of this, and this is something that's sort of new to them. So lo and behold, the residential cost aggregator, as I was mentioning, the software was created to provide tax preparers, and it is really designed. The focus and the design of the software was with CPAs in mind. It is sort of focused and designed to be a tool for CPAs, but it doesn't prevent those if there's taxpayers or clients or property developers that are on the line today that they can't be used by you as well. But it was designed to assist tax preparers and provide them a tool to allow them to prepare cost segregation reports on these smaller residential properties without the need of hiring a third-party professional, doing a full-blown analysis, having an engineer, doing the site visit, and preparing it. So significant cost savings, significant less hours, a tool that allows them to do a much more condensed version of a cost seg by using basic information about the property, allowing the building owner themselves to fill out the survey and put the time in and fill out the information about their property details. The software then provides a detailed cost breakdown of the property. And I said, remember, as I mentioned before, the two goals: categorized by tax recovery period category, and then also itemized by unit of property. And then this report can be used for income tax depreciation purposes. And all of this is really done and accomplished by using empirical construction cost data, the same cost data that goes into doing a full-blown analysis, the same resources and tools that we use to support and prepare our full-blown analysis is working behind the scenes of this software as well, along with proprietary algorithms written by KBKG cost seg engineers. So most reports, result in significant cash tax savings and significant deductions. And for some of these taxpayers, these are very sizable. I understand that the basis is low and these properties are a little bit smaller, but understanding the type of taxpayers that are likely investing in these types of properties, these could be quite significant, and especially compared to the cost of the report, as you'll see very soon, it can provide a tremendous value. They're designed in a way to be easy to use. It takes less than 15 minutes of time to prepare. As I mentioned, it's a tool for CPAs, used by CPAs so that they can then pass that questionnaire along. It's to their property owner. It's a simple questionnaire. They can fill out the facts. They can do the work, and they can do some of the legwork. It comes back to the CPA pretty much prepared, where the CPA would really just have to kind of put a set of eyeballs on it, review, make sure things are looking, do that sanity check before they actually hit the button and generate a report for themselves. It's a white labeled report, so our logos are not on there's no KBKG logos. It's designed so that the CPA can even put their own logo and really provide this as a value add service to their clients, something that they can even present to their clients as another service offering that they provide, along with maybe the compliance and tax preparation work that they're doing. It comes with our free audit support. KBKG stands behind the work that we do. We get that question a lot. It's not often that you have a lot of service providers out there in the marketplace that are going to stand behind their work for free. But we do that with all of our cost seg studies, and we even do that with these softwares, these software reports as well. They are simplified so that they can easily be uploaded into our 481A calculator as well. You can print them out in a PDF format or Excel format, as I'll show you a little bit later in the live demonstration. So they are a little bit user-friendly and modifiable in that way that you can actually copy, paste them, and upload them into the format that you need to do. We do see, as I mentioned, tax preparers or CPAs are charging upwards of $1,000 or $2,000 of their own professional service fees associated with putting these reports together. So the cost of our report plus maybe some of their professional fees to do some of the work, very, very cost-friendly way for properties south of that $500,000 cost basis level. So we always recommend 3 steps when considering the residential cost aggregator. Go to the website, take a look at the product, estimate the potential tax savings for your client. There is a little estimate box for you, so you can even see, is it worthwhile for you? Step 2, if you're interested in pursuing, you send that survey link to the building owner, and they can fill out the information for the building, as I'll walk you through. It comes back to you, the person who initiates this survey link. You get to review the information. You get the final say to actually pull the lever and generate the report and use up one of your report credits. And then you have a cost segregation report complete with all the detail that you need to implement into the return. And then step 4, it's optional if you do need to, if this is a prior year acquisition, upload this into a 481A and calculate that catch-up deductions, as I was mentioning before. I'm going to come back to this slide, or actually, Ellen, I'm just going to exit out of the webinar, so bear with me, folks, as I launch into the live demonstration here. And I'll zoom in a little bit. So this is the KBKG website, and I hope that you guys can see my screen well. Ellen, please do let me know if you can see everything. So this is where we recommend. Okay, thank you. This is where we recommend everybody starts. This is the KBKG website. This is also probably the area where you went to log into our webinar and create a profile and create your dashboard on our solutions website. You can find out more information on the residential cost aggregator or all of our softwares under the software menu item. So you'll see residential cost aggregator, partial disposition calculator, two of the softwares that we will highlight in today's webinar. But we do have other softwares on here, the 41A, as I mentioned. Click on the residential cost segregator. This is where I was recommending that if you want to find out some more information about the software, you see some features about the software. You'll see the price point as I discussed before. Very, very affordable price point. There are discounts available if you are purchasing multiple reports. You can watch a video demonstration, which is really helpful. It's a quick video that goes through 15 minutes of how the software kind of works. You can see a sample report. And this is where I said I recommend you start. Step number one. Step number one here: preview your benefits. Is it really going to be worthwhile for your taxpayer? You put your property address, 123 Main Street, and the purchase price was $450,000. This was maybe a single family home, and I want to stress the software is limited to a tax basis of $500,000. That's building tax basis. So if the property was perhaps purchased for $600,000 and $150,000 was the value of the land, your building basis is $450,000. So it's not the property purchase value, it's the building basis value that's limited to 500. So just remember that. I'll just pick January 1st, let's say 2017. I'll say 17 here. I won't say 2018. So bonus really is not applicable. $450,000
Hey,
property act.
there you go. I was just going to ask you to zoom in, Sumit. Thank you very much. You read my mind.
Yeah, I'm sorry about that, folks. I just realized I should zoom in here. It's a $450,000 building acquisition, residential single-family home acquisition, 2017. No bonus. You can play with your present value factor. You can play with your federal and state tax rate. You can play with all of these factors. What year are you going to be applying the study? Is it for the 2018 tax year? Is this for maybe a future tax year? Let's just say it's going to happen for this year. Does ADS depreciation come into play? So you have some flexibility here. Preview your tax savings. So for a $450,000 residential single-family home, we're looking at roughly about $17,000 to $26,000 of additional deductions in year one only. Over the next 5 years, you're looking at about $33,000 to $50,000 of additional deductions. Tax affected, that's an increased cash flow of $7,000 to $10,000. A net present value of doing the study of close to $8,500 to $12,000. Very significant, very significant savings here, especially when you saw the cost of the report at $400 for the cost of the report. Maybe you tack on $1,000 or $2,000 of your professional services, so around $1,500. I mean, these are real dollars for our taxpayers and for our clients. This is quite significant to them. You can see a little chart here. You can print this chart out. So now that you've estimated this, you're interested in pursuing the software. You want to get started. You can purchase the report, but it all starts here. So this is this KBKG solution site where you likely logged in to register for the webinar. I'm going to log in myself. So you can see this is my dashboard. I have 3 reports available. It seems these are some of my other subscriptions to some of my other service softwares. So if you click on the residential cost segregator, this brings you to your segregator dashboard within the solutions website. You can look at prior reports that you've prepared in the past. So you can always access something that you've created in the past. And just give me a minute, it's taking a time to load here. So the question, a single family home costing $80,000 to $100,000, is it worth it? Absolutely. Absolutely. You should preview those benefits. I definitely, take a look at the benefits and you can kind of estimate for yourself. And I'm wondering why this is taking so long here. I apologize, folks. Try again. Here we go. So you can see I've done several of these webinars. These are all sample reports that I've done for prior webinars and prior demonstrations, but you can always access your report. You can see the results, you can print them out. But what we're going to do, we're going to create a new report. So you come here, you create a new report. You realize, this is something, this is going to be a tool that's worthwhile for you. You're a CPA, you have a client, they purchased a $450,000 home, and you want to send them an invitation link. So this is where you click send invitation link. You can send it to your client. You can send it to your client. You can change the subject. It's a very generic email. You can modify the text in the email, but basically it's an email with a survey link, to your client, Mrs. Client, please take a look. Please fill out this survey. This will allow them, they're the property owner, they're the developer, whoever, they know their property better than anybody. They can fill out the information. You don't have to fill out the information. When they've completed it, it will come back to you. So once you've sent them that invitation link, the person will see a screen very similar to this. They can put in the address. They can put in the address. They can put in the cost basis. I believe I did January 2017, I believe. You can see that there at each option, there's a menu. You can choose different things. So you can see different types of properties: condos, townhouses, duplexes, apartments, single family home, as I mentioned. So there's different property types. You'll also see there's lots of these question marks, and these question marks guide the user how they should be answering the question. What does it mean? Is it average quality? Is it high quality? I don't know how much my square footage. I know I have an acre lot. Okay, well, 1 acre is equal to 43,560 square feet. Okay, so 43,560 square feet. Do I have the basement? Yes, it's unfinished. What's my exterior wall type? Is it stone? Is it wood? Is it stucco? I'll just use stucco for now. How many stories is your single family home? So you have a lot of options to customize it, and I'll just I'll go average construction quality. Or maybe I'll do average construction quality, physical condition. I'll say it's excellent. It's in great condition. I bought it. It's in great condition. So I've put in the general information. They can go through, and you see that there's different screens. They'll input information about the interior of their property. How many bedrooms? Let's just say 3 bedroom, 2 bath, no fire sprinklers. You can even customize the type of flooring per room. What kind of flooring in the kitchen, in the bathrooms, the living rooms? What kind of heating, cooling system do you have? I'm not going to really spend too much time here. I'll just kind of click around, say that there's tile in the bathrooms, tile in the kitchen, master bedrooms. These are all carpet. Hallways are carpeted as well. So this is in New Jersey. I'll say heating and cooling. It's a central system. Maybe I'll put in a couple of ceiling fans. You even ask what kind of window treatments, what types of window treatments are there? What kind of appliance packages do you have? Dishwasher, oven, refrigerator, microwave, washer, dryer. So I'll click some of these. The exterior, it asks attached garage, detached garage. It has space for maybe 1 car inside, 2 cars on the driveway. Is there a pool? Do you have a patio? Is there some landscaping? It's based on the facts and parameters that you're plugging into this algorithm and this model. It's building this estimate and based on the average quality or the quality type of construction. So all of these things have a factor. Is there walls? Are there fences? So maybe there's a 100 linear feet of wood fence. So once this has been complete, the person who's filling out this survey, property owner, whoever, would save it and send the link back to you as a CPA. As a CPA, it would allow you to input the combined federal state tax rate that you want to use, what return on investment you want to use to calculate 7 or 29. We'll leave it at 8%. I'll leave it at 40% because I think if we looked at our preview, I think, I used 40 and 8 in the last scenario, so I'll keep things the same. And we are doing this for the current year, 2018, no bonus, no ADS. So once those things are done, oh, you know what? I never even put a square footage for the building. I'm sorry. So let's do a 2,300 square foot single family home or something like that. So once it's been complete, I'll zoom out just a little bit, but it allows you to scan everything, and it asks you, please confirm that all the information is accurate. Because once you hit this calculate button, this disclaimer is going to come up. And this basically disclaimer is kind of warning you that once you've agreed to here and you actually hit this button, you are going to use up one of your report credits. So it is going to, you know, the report that you've purchased, you're going to use it up. So be sure that you reviewed everything, you've blessed it, it looks good to you. So I'm going to hit proceed with calculation. And it's generating a report right now. So this is the report. You can print the report as a PDF. I'm just gonna show it to you on the screen here, but it goes through all of the facts that we've plugged in. So the facts about the property itself. Where did I do here? The facts about the property itself, the additional cash tax savings. So when we previewed, we were between 17 to 26,000, and lo and behold, we came towards the high end of that because I did kind of click a lot of carpeting and appliances, and you know, there was a lot of, I put 3 bedrooms, 2 baths, so there was a lot of features that I put into that house, if you were noticing. So we did end up towards the high end of that range, significant savings. So you'll see that $450,000 tax base is broken out between the 5-year property, 15-year land improvement property, and real property. And then the most important thing and most useful thing, I think, is down here. This is the itemization, as I mentioned. So not only the categorization into tax lives, 27, 5, and 15, but item by item by item, doors, windows, roof, structures, the roof structures, the electrical system, the HVAC system, the carpeting, the appliances, the features on the site, fencing, the deck, patios, what have you, item by item by item, all totaling to your $450,000 tax basis. So very useful. I mean, this is, you know, essentially you could preserve this data into whatever software, tax software you're using and implement it. So it's very handy, especially for future reference. This can be exported into Excel, so that the schedule that I'm showing you right now can be exported into Excel, so you can easily copy, paste things, you know, as you need to. And also you can see there's other buttons up here. You can save it as a PDF report. It's white labeled. There's no logos. There's room on the PDF report so that you can print it on your own company letterhead as well. And then you can also upload it right here. And I'll click this button. I'll show you. So this was purchased, as you remember, I did a $450,000 single family home purchased in 2017. So, okay, purchased in 2017, that must mean I placed it in service. Well, I must have some accumulated depreciation. I don't know, maybe I'll just make up say I have $10,000 of accumulated depreciation. I'm just making that up. Company name is XYZ. So you have your tax year, and so this is going to be for the current tax year for 2018. So for my tax year ending on December 31st, 2018, tax rate 40%, return on investment factor 8%. I purchased it $450,000, 2017. I had $10,000 of accumulated depreciation. I purchased it and I placed that in service as a residential property, straight line, 27.5 year. I purchased the residential cost segregator. I came up with all of these results. I clicked on the 41A calculator. You can see it pre-populates all of the detail that I was showing you before. So I can now calculate. I can calculate what are all of those missed deductions that I missed in 2017, and it can show you here. So it's showing it up as a negative, but a negative, remember, is taxpayer favorable. So there's about $14,000, over 14, almost 15,000, I should say, $14,833 of deductions that were missed that I can catch up in the year 2018. So this is, you can see the old depreciation under the old method, so that adds up to the $10,000 that I took in 2017. But under the new method, with all of these 5-year and 15-year, I should have actually had $24,000 of depreciation. So that missing that difference, that 14,000, I can catch up on top of my 2018 depreciation deductions. So 2018 is really made up of two parts: the current year deductions plus the catch up. Keep that in mind. So this is a snapshot. I'm actually going to relaunch the webinar. So this, on the screen here, generally you'll notice that the higher your depreciable basis, the higher benefits are going to be from the study. Naturally, also, the placed in service date also has a big impact on the increased deductions, especially for year one deductions. If you're catching up deductions, or if you're taking advantage of it in the current year. So I always recommend that you take advantage of that built-in tool to preview your tax savings to see if it's likely to make sense for you before you actually purchase the software or purchase report. Definitely use that preview function. It'll give you a good sense, but you can see, some of these deductions and some of the net present values of these studies, very significant, very meaningful for taxpayers. A couple of these slides are going to be redundant. These are screens that I just walked you through that you just saw. Just a few minutes, folks, and I'm going to move quickly through this. It's another tool that I want to walk you through. But the current regulations allow taxpayers to take a loss deduction when they remove components from their building. So, for example, if a taxpayer paid $50,000 to replace all of their HVAC units in their building, they would need to capitalize that amount and recover that and depreciate that over 39 years. However, they can figure out how much the cost of that old HVAC unit is, that if it's not fully depreciated, and claim that amount as an immediate deduction, as a retirement loss. And so we have a couple of slides that kind of go through this, so you can see this example and you can see the impact this has. Suppose a taxpayer acquired a building 3 years ago for $5 million. This year, in 2018, they spent $1 million to remodel a part of that second floor. They did ceilings, walls, lighting, plumbing, all sorts of kind of work for $1 million. If we analyzed that original $5 million building, basically we would have identified that there's maybe $470,000 of components that were demolished from within that $470,000 from within that $5 million building acquisition. The taxpayer would essentially now be able to recognize a loss. So of that 470, maybe 40,000 has been depreciated over time. So there's a remaining basis of $430,000 on the current in the current year. You get a $430,000 loss essentially, and and it can be taken immediately on the current year. I think I advanced the slide too quickly. So based on the final disposition regulations, there's a couple ways. The regulations allow taxpayers to discount the cost of that new component. So basically, you can discount the cost of the replacement component, and you can discount it backwards to identify what is the value of that old asset that has been replaced. However, a word of caution that we recommend to folks is that method can only be used when you're restoring property and not when you're bettering property. And also, it doesn't account for condition factor. So what was the condition, at the time of the acquisition? So for example, and you can see, you can use this producer price index to discount the value. If you paid $200,000 for new windows today, using that producer price index, you can discount the cost of those $200,000 windows to figure out what was the relative value of those old windows that I'm replacing. But on the next slide here, and this is really the most important thing, is why the condition of the components needs to be considered when using the discounting approach. So suppose that building was acquired 3 years ago. The owner spent the $200,000 to replace their windows this year. You discount using the PPI, and you basically identify that the cost of the new windows would have been $186,000 when placed in service. However, this essentially represents the cost of brand new windows. We need to make an adjustment to recognize that the windows were not new when the building was acquired 3 years ago. So one way to do this is to consider the normal expected life of windows, which is 20 years. If we had replaced the windows, 3 years after acquisition, we may assume that the windows were effectively 17 years old. So applying this condition factor, using this condition factor would result in a true valuation of these old windows of around $50,000. So significant difference there between the 186 and the $50,000, and it's something to kind of keep in mind. There's a link here, and I suggest you go to it, which talks about a B&A article that talks essentially about the restrictions and warns the taxpayers about the use of the discount value approach. So we're going to go into a live demonstration. This next tool is essentially going to be walking you through that exact calculator. You always start, once again, at the solutions website. So on the solutions website, you'll see that this is the partial disposition calculator. This is what the partial disposition calculator screen looks like, and I'll zoom in again. Hopefully it's legible. I did get some comments that it was hard to read. So Ellen, let me know if this is legible. So I will use $200,000, as we said in that last example, new components. And this happened last year. So they did it in July of 2018. The original building was a $5 million building that they had bought. And no cost site was ever done. So it's simply on the books. It says $5 million. It says building. You say, hey, Sumit, KBKG, I have no idea how much the value of the windows are within this $5 million. All I know is they spent $200,000 for new windows. I'm capitalizing that cost in 2018. How do I figure out how much the windows are within this $5 million? This is what this tool is designed to help you with. So that $5 million building, I think it's at 3 years ago, right? So 2015. So purchased January 1st of 2015. 3 years later, they're making the window replacements. It was purchased in 2015, but let's even say this. It was actually built in 2010. There was a 5-year-old building that they purchased in 2015 for $5 million. The accumulated depreciation on this property over the past 3 years, let's just say, I don't know, $60,000. You can even put in state accumulated depreciation, AMT depreciation. I'll move a little more quickly. There's only a few minutes left. So this is where you can search for the component, whether it's windows or whether it's doors. I like to use the drop-down menu. The drop-down menu is pretty handy. You can see windows. Okay, well, what kind of windows? Aluminum windows, vinyl windows. You can choose lots of different components. It pre-populates the normal life of that component that you're choosing. So once again, $200,000 for windows. Once you've filled out this information, you can calculate what your PPI adjusted value. So just using the producer price index of that $200,000, it would give you $149,000 is the adjusted value for the components that are replaced. But remember, it doesn't take into account the condition factor. But taking into account the condition factor and taking also into account depreciation that's been claimed. So your your unadjusted value was 186. Taking into account the condition factor, it's 149. But then taking into account accumulated depreciation on this 149, you have about $147,000 of adjusted remaining basis left in those old windows that were replaced. So of that $5 million building acquisition, $147,000 is the value, relative value for your windows. And that's how you can essentially identify your retirement loss for 2018. And the retirement loss must be taken in the year that the activity was incurred. So with that, that was the conclusion of our presentation. I just hit the 1 hour mark. Here are some screens that I've just walked you through about the partial disposition calculator. that I just showed you. There's a couple of bullet points here. How, what are some of the qualities of a certified cost segregation professional and a quality service provider in the cost segregation industry? We do recommend. I mean, I like to send people to our website. It's quite robust. There's a wealth of information on our website, and we really hope you consider our products and our tools. My contact information is as follows. Please reach out and let me know if you have any questions. And once again, thank you everybody for joining us.